Welcome! This video will be covering section F2 of the capstone, the forecasted balance sheet. The forecasted balance sheet will be the second tab within your financial template, where you will develop a forecasted balance sheet for the end of your company's first year. So keep in mind there is a difference between the time frame covered in the profit and loss statement and that within the balance sheet. The profit and loss statement covers a period of time, that first year of operations, whereas the balance sheet you're going to present is going to be at the end of that year. So if your company is operating under a calendar year, going from January through December, your balance sheet would show as of December 31st. If your company was starting in June and ending their first year in May, your balance sheet would be presented as of May 31st. So it is a one-day statement, whereas that profit and loss statement covered that period of time. As the name implies, the balance sheet does need to balance. The top half of your statement is going to list your company's assets, such as inventory, cash, accounts receivable, computers, equipment. And then the bottom half is going to address your company's liabilities, such as salaries payable, accounts payable, and loans, along with owner's equity items, such as retained earnings and owner investments. That top portion of your balance sheet, or the assets portion, needs to equal the combined total of the bottom portion. Going back to that basic accounting equation, your assets have to equal your liabilities plus your owner's equity. If your total for assets is anything different from the total for your liabilities plus your owner's equity, your balance sheet will be returned to you for revision. So you definitely want to make sure that the math is done properly and all the individual items total up to match that accounting equation. Now, taking a quick look at the various sections of the balance sheet, starting with the top half, our assets section. In this area, you're going to show items that are controlled by your business or owned by your business. And assets can be either current, meaning that your company is intending to use that asset during the next 12 months, or they can be long-term assets, meaning that it will take you longer than 12 months to utilize that asset. So for the capstone, current assets are typically going to be things such as cash, which every company is going to have. You need an account to pay your company's expenses. You need an account to collect money from customers. If you're letting customers take some time to pay you, you may have some accounts receivable. This would be any amounts owed to you by customers on the last day of the year, and that's usually going to be no more than a month of your company's revenue. If you're selling a tangible product, you may have some inventory left on hand at the end of the year. And this could be either raw materials, work in progress, or finished goods that your company has. Now, long-term assets, as I said, are going to be things that last your company a long period of time. So these are going to be things such as land, any fixed assets that your company may own, such as computers, vehicles, furniture, equipment. And some of you may have intangible assets for your business, such as any potential copyrights or patents. Moving along to the bottom half of the balance sheet, starting with liabilities, these are going to be debts or obligations of your business that you owe to outside parties. And again, just like with assets, liabilities can either be current, meaning your company will pay it within 12 months, or they can be long-term, meaning that your company will take longer than 1 year to pay those obligations off. Now, most businesses are going to have some current liabilities, and these will be things such as accounts payable, which would be bills that your company has received, but you have not yet paid. So this can be things like utilities, phone, you've received the bill and haven't yet made the payment on that service. With accounts payable, it's usually going to be no more than 1 month of your expenses, with the exception of wages, which are usually going to be shown separately as wages payable or salaries payable. And just like with our accounts payable, usually no more than 1 month of salaries. Keep in mind that a lot of companies pay their employees every 2 weeks, so maybe a half a month of salaries is what you still owe your employees at the end of that year. And then if you are paying taxes, you may have a taxes payable account for amounts owed on your tax payments. Now with long-term liabilities, for the capstone, usually the only thing you would have in your long-term liability section would be any long-term loans, the balance that would be remaining at the end of that first year. Now, if your company is not taking out a loan, the long-term liabilities section would be the one section that you may not have anything listed within it. And then finally, the last portion of your balance sheet is going to be your owner's equity section. And this is essentially the owner's share of a business, including what you've provided to the company and what the business has earned and retained through operations. Now, depending on the company's structure, there can be multiple accounts that make up equity. You may have common stock, paid-in capital, owner investments, withdrawals, retained earnings. But for the capstone, all balance sheets should have a line item entitled retained earnings. And this retained earnings figure is essentially the link between the revenues and expenses on your profit and loss statement and the items on your balance sheet. This is going to be how that earnings gets carried forward to the next year. So the retained earnings figure within equity should be the same as your annual net profit loss figure from your profit and loss statement, that very last number on the statement. So here we can see an example of a completed balance sheet. Now for the capstone, we do recommend starting at the bottom and working your way up through the balance sheet versus starting at the top, as you would if you were preparing a balance sheet for a company that's already in existence. And this is because it's a little bit easier to estimate or forecast some of your liabilities and equity rather than your assets. So if you start at the bottom of your balance sheet, starting in your owner's equity section, as I just said, retained earnings is going to come right from your profit and loss statement. It's going to be that annual profit or loss. So you can bring that figure right over from your completed profit and loss statement. And then from there, usually you're only going to have one other item in your equity section, any owner investment. So this would be amounts either of items or of cash that has been provided to your business. And owner investment should be shown at the full value provided. So in this case, we see that $50,000 has been given to the business. Now, if the company spent $30,000 of that, we don't want to show the remaining $20,000. We still want to show the full value that was provided, the $50,000. And so once you've completed your equity section, you can move up to your long-term liability section. And usually the only things that are going to be in here are long-term loans. So we see this company does have a loan. They have a loan payable of $7,500. Now, where loans are a little bit different from owner investments is that owner investments are shown at the full value provided, whereas loans are going to be shown at the balance remaining. So in this case, the company took out a $10,000 loan. They've paid down $2,500 in principal, so they currently owe $7,500 at the end of that first year. So then we can take a look at our current liabilities section, keeping in mind that our current liabilities are usually going to be no more than 1 month of expenses. So we see the company has some accounts payable of $1,700, wages payable of $6,250, and then some taxes payable of $3,000. So once you've completed your equity and your liability sections, you can then reach the bottom total. Total liabilities and owner's equity. In this case, we see $77,274. So once you've completed the bottom total, we now know in order to keep our accounting equation in balance, our assets have to equal the same amount. So we can move up to our long-term assets section, come up with the big items that our company needs. In this case, we have some equipment, furniture, and a vehicle, totaling $42,500 in long-term assets. Then finally, you reach your current assets section. This company has some inventory on hand of $500. They do have some accounts receivable amounts owed to them by customers at the end of the year, usually no more than that last month of revenue. We see that this is $7,500. And if we've estimated everything else at this point, we're left with cash. So you can use your cash account to balance your statement out, to get your total assets to equal your total liabilities and equity. So in this case, we needed $26,774 in cash to balance our statement out. And as long as that cash figure is reasonable, it's not a negative number or way higher than what's been provided or earned by your business, then it's safe to assume that that's somewhere where your cash would fall at the end of that first year of operations. Now, these next couple of slides just walk through that same process I just walked through while we were looking at the balance sheet. So definitely take advantage of these slides while you're working through your balance sheet to follow step by step along with what you're going to need to do in order to follow that bottom-up approach. Well, I hope this video has been helpful in working through the balance sheet for the capstone. If you have any questions or concerns as you're working through the statements, please don't hesitate to reach out to any of the course instructors.